So, well, on top of uncertainties in global markets, central banks are faced with structural changes driven by digital revolution. In our second session, we will be exploring the important question, is there a role for cryptocurrencies? We have the perfect moderator for this session, Governor John Rolle, who has been the governor of the Central Bank of the Bahamas since 2016. Before this, John Rolle served as a financial secretary in the Ministry of Finance, and then from 2009 to 2012, Mr. Rolle was seconded to the executive board of the IMF as a senior advisor to the executive director for Canada, Ireland, and the Caribbean constituency. Please join me in welcoming Governor John Rolle and our speaker, Christine Parlour, who will be present her research in this timely subject. Please welcome to the floor.
Thank you. I will show signs as to how many. Okay. Yeah. I think you're here. So, good morning to you all, and thank you, Anna, for the introduction. And let me say thank you again to our colleagues at the BIS for this very important conference, and to you, Tobias, for a great previous session. So now we're going to shift gears and turn to a topic of high interest for central banks across the region. And the question of this session is there a role for cryptocurrencies? And we're very pleased to have Christine Parlour here to give us her research-based views on this topic. Christine is the Sylvan C. Coleman Chair at the Haas School at the University of California at Berkeley, and she's co-director of the Berkeley Center for Responsible Decentralized Intelligence. She's done extensive research on cryptocurrencies and decentralized finance, mining collusion, and the workings of automated market makers in decentralized exchanges. And she also teaches a massive open online course on decentralized finance. So today, Professor Parlour will be drawing on her current research about the role for cryptocurrencies in areas like payments and clearing and settlement and trading. So it's my pleasure to hand the floor over to you, Professor.
Thank you very much. And thank you for inviting me to share some of my sometimes preliminary research. I guess the question is there a role for crypto? And as most academics, I will say maybe. But I think one thing that is true is that this is coming, and there's nothing we can do about it. And so it's useful just to think about what's coming down the gangplank. So what I wanted to do in this short period of time, I can't quite see the timekeeper, but, oh, I can't see you. That doesn't help much. Okay. So I just wanted to point out a few things. So one, I want to talk about payments, so basically stablecoins and how they're used. A little bit of digitization, but Hyun is going to presumably talk about it much more. And then talk a little bit about how some of the novel market designs that we see in crypto could potentially be incorporated into what we think of as traditional finance. So we've been looking at payment flows on the Ethereum blockchain. There are other blockchains, but this was just to get a sense of what people are doing. So on the vertical axis, you just have the number of transactions. These are in thousands, so there are not that many of them across time. And we have three different stable coins. DAI, which is crypto collateralized, so it's a completely native blockchain one. USDC, which is issued by Circle, so it's backed off-chain by collateral, and USDT, which is also backed off-chain by collateral. So the green is the USDT, right? How much money is being transferred? So as you can see, the amount of money that's being transferred by the USDC, which is the Circle-based US dollar coin, much, much higher, right? So the number of transactions are lower, but the volume being transacted is higher. What are people using these things for? So this is just USDT, so Tether, and basically it's broken down into 3 different segments. The top shows transfers or a fraction of the volume that's going to centralized exchanges. So these are people who are putting in and out of crypto trading venues. The blue is going to DeFi protocols, so this is being used as collateral. And the green is user. These are people sending dollar amounts to each other, wallet to wallet. So the question is, how much or how pervasive is this? Well, we look at what we call periodic payments. So we basically look at pairs of wallets and we say, okay, is there a systematic payment from wallet A to wallet B at some frequency? Right? And so on the y-axis or the vertical axis, you see the number of periodic payments per day. Perhaps not that much, but it's useful that this is being used systematically. Once again, Tether is predominantly being used for these periodic payments. How much money is being transferred? And this is in millions of dollars on the y-axis. And basically, Tether, by far and away, is the largest way in which people are periodically, consistently sending and receiving payments. So this is being used as a proxy or being used instead of a traditional payment rail, right? So what do we want to think about this? Well, this raises a whole bunch of different questions. Pretty clearly, if you're using money through stablecoins, you're disintermediating banks. Banks are not, the payment role of banks, they have reserves or they have money sitting there, no longer happening. Is that a bad thing? Well, it's not obvious. It's not obvious that we want the same institution to process payments and also to make loans. To some extent, they're distinct categories, and the payment risk is presumably one of the reasons why we regulate banks so much. One of the benefits of stablecoins is they're potentially cheaper, and as we know with traditional payment rails, there are a lot of network effects that make competition difficult. So basically, maybe this could be a good thing. So it could encourage competition. One thing that's a huge distortion as these volumes increase is moving money away from the real economy. If all these stablecoin issuers are basically putting their money into treasury, what we're doing is we're having a transfer from presumably, small business lending or the other things that we think banks do to essentially investing in the government. And the question is, do we want to do that? And is that a good thing? And that, I think, is something that regulators should think about. There are complicated issues here, obviously. Going further, there are other things that have arisen that are looking a lot like banks. In particular, there's a movement to tokenize real-world assets. A lot of it has to do with reducing the costs of clearing and settlement and just making everything move more smoothly. What's in particular interesting is that people are tokenizing treasuries. So they go out, they buy an ETF, they tokenize it, and then they issue claims against that treasury. So effectively what you have is you have something that is pegged to the dollar. It is a means of payment, but it is also interest-bearing. That looks a lot like a bank account to me, and we'll see where it goes. There's a consumer one called Ondo Finance. They do this for retail. The BlackRock one, which is sort of interesting, has a minimum threshold of, so it's only for qualified investors. So you basically have to put in a huge amount in order to get one of these tokens that are issued on the Ethereum blockchain. People have been trying to use these as collateral in other sorts of traditional financial arrangements. And so now you're starting to get a huge amount of interconnected movement of tokens that I think would be useful just to think about very carefully. The other thing that I want to talk about, if I have time, is just some of the new institutional forms that are arising. I'm sure you've all heard of decentralized exchanges. The product Marianne was sort of useful. But one thing that's sort of very interesting to notice is that these are designed very differently. So the way that we regulate traditional exchanges when we think about what enhances illiquidity, how we want things to behave, are very, very different. So these structured differently, they should be regulated differently. Interestingly, Uniswap has come up with a new version It took us a long time to figure out V2, V3, but now we got V4. What is unusual about V4 is it allows people to develop customized on-chain trading platforms that have what are known as hooks. Hooks essentially are conditions that you can check before you allow people to trade. So you could potentially do this, make wallets whitelisted. You could potentially make sure that things have gone through a KYC process. So this is something that basically makes it really, really easy to move regulated assets on-chain. So something to think about. The final thing that I wanted to throw up, and of course I kept the most complicated thing for last, is something known as liquid staking. Liquid staking is what? So in order to maintain the consensus of the Ethereum blockchain, you basically need, under proof of stake, to essentially deposit collateral. That collateral generates returns, so there's a flow of value that comes from this staked collateral. The minimum amount of staked collateral is large. So a series of intermediaries, there are approximately 3 at the moment, have arisen that basically say, okay, you don't have a lot of Ethereum, so what you can do is you can give me your Ethereum and I will put it together and I will invest it in this illiquid asset, which is the staked amount on Ethereum. Okay. So, thank you. Effectively, you have something that looks like liquidity transformation. You have people who are taking a liquid asset, Ethereum, depositing it in an illiquid asset, which is this consensus value generation, and we go from there. The solution that people came up with, because people don't like having illiquid assets, is to do what is known as liquid staking. What does that mean? If you have a stake in one of these protocols, Lido in particular, what I'm going to do is I'm going to give you a receipt token. Now you take that receipt token, and if you want to cash out and eat today, you can sell that receipt token on very, very active and vibrant markets. So essentially what happens is you have things that are deposited in as illiquid claims that now are basically liquid. So this is, I don't know if you remember Jacqueline's critique on the bank runs, but he basically said if you had some sort of, instead of having a deposit contract, if you had something like a dividend paying stock, well basically, and you had a market where you could trade those stocks, then basically you could get rid of the bank run problem. This is what liquid staking is doing. So this picture basically gives you the staked ETH against ETH, and that's the blue line, and the red lines are basically withdrawals, and it basically says that the price between the deposit and the deposit receipt is it pretty much keeps its value. So this is something we're looking into. Just as sort of a broader thing, we started to sort of dig into this theoretically, and we basically actually think that having this liquid market can make the situation more volatile. And the issue is that markets do 2 things. They allow me to trade, but they also give people information. And the minute you have information and people are sensitive to that information, you can increase the probability of a run. So it's something that has to be looked at very, very carefully, especially if we move to a regime of digital deposits. Bottom line from all this, automating finance, and this is what it is, right? So the crypto is basically automating finance. Provides opportunities for efficiency, no question about it. We have natural monopolies in a lot of the financial sectors, and so this is sort of a way of potentially giving gains to trade or gains to competition. However, it requires really, really careful regulatory scrutiny, and that is because the business models are so different from the business models that we see in traditional finance, and our regulatory structure is built to cope with the way things were yesterday, and they're going to look a lot different. Different people are going to be pushing different levers in a different way tomorrow, and that's something that we should think about really carefully. The final thing is inherent to any kind of cryptocurrency or digital asset is rehypothecation. Everything moves through Okay, I've got an asset, somebody gives me a receipt token, I move that somewhere else. Now we have interconnection between different protocols on a massive, massive scale. And this is something that presumably or potentially has a potential for systemic events. So excitement, but also caution. Thank you.
Thank you very much. I have a longer list of questions than the time will permit, so I'll be very selective. Yes, first question, and then we'll get some questions from the audience if time permits. But the Bitcoin was cited as an example that was introduced to address payments and other shortcomings that were perceived in the market. But in practice, it's more for a speculative investment instrument. Do you see a future in which cryptocurrencies and decentralized finance play a larger role in the payment space?
So unless they're tied to the unit of account, they're not going to make any sense, right? The volatility is too high. I mean, the stable coins are the only ones that are going to be useful. I mean, in a world in which everything in the universe was denominated in Bitcoin, that would be different. But I don't think it's ever going to happen unless it's through stable coins.
Okay. Now, I was glad that you introduced staking on one of your slides because it has come up a lot, and the deposit-like characteristics. Should we be thinking about regulation from the point of view that in the mainstream we have deposit insurance, protection of depositors? Are they venturing into the banking space when this starts to happen?
So the similarities are obviously very, very clear. When it comes to regulation, I guess the question always is, what is the market failure? If we think that maintaining the integrity of these blockchains is sufficiently important from a systemic point of view, then yes, obviously you want to think about regulation. But if we think that this is something that people are doing on their own purview, then I would say not. So it requires a policy view on what we think cryptocurrencies are and how they should be integrated into the economy.
So I know that insofar as the technology is concerned, blockchain, tokenization, a lot of that is being adopted in the mainstream. But in terms of the product and other services gap that crypto was supposed to fulfill, have you seen, in your view, a meaningful or sufficient response from mainstream finance to address those concerns?
So in mainstream finance, there's a lot of like faux crypto activity. I don't know if you remember when there used to be massive returns to putting X at the end of stocks. There's a lot of sort of hoopla around trying to make people think that this is something new and something good. There hasn't been, as far as I can see, a complete integration of traditional finance with crypto. That said, there are a lot of, like Franklin Templeton, a lot of the large fund managers are seeing the potential of sort of automating the back end. And so they're viewing crypto as being potentially an interesting thing that they can be part of. So I think we'll see more of that.
Okay. So how do you assess the impact of the new U.S. administration's regulatory stance on cryptocurrencies and decentralized finance? Do you expect a regulatory stamp of approval for stablecoins?
I think, the new administration has said very clearly that they're crypto friendly. What that's going to mean exactly, we don't know. I mean, one of the issues in the US up to this point has been complete regulatory confusion about whether or not these are good things, whether or not they're bad things, who of the many, many, many regulators they fall under. I mean, other jurisdictions have been very careful about carving out digital assets and being careful about, mining, who's holding them, and sort of providing essentially a legal framework for people, if they want to be serious about it, to enter into this space. So where the US is going to go, I don't know, but I think, they're working towards having some sort of coherent regulatory framework, which I think will be a good thing.
Okay. So do you anticipate any impact on adoption?
Absolutely. I think there will be, if the US comes on board and things start becoming sort of official policy, as you know, governments can push things in directions pretty quickly. And so if they're serious about it, I think there will be massive increase in adoption, yes.
Which means then that it accelerates the way we think about regulation, because then we have to be concerned about the level of sophistication of all of the new users in the space. Yeah. And I think just judging from some of your other work and the range of risk that are in these assets, it certainly makes a very interesting time ahead. I think we're going to have maybe 2 questions from the audience, if there are any. Yes. Just use the microphone, please. Yes.
Hi, Chris Rolle from Georgetown. Good to see you. I think the question I wanted to get to was the one that was just brought up, particularly with regards to information. One of the challenges of liquid staking is how do different protocols interact with one another? What's the sophistication, for example, of the users? And when you start to think about the technology and how one piece of technology, one piece of code sort of interacts with another, you get different kinds of transmission of risk on the one hand, and that sort of points its way to one kind of a regulator. But then you have, again, this user risk, the kind of consumer protection, informational risk that you get that's tied to all kinds of things that even traditional securities law doesn't necessarily anticipate, in part because of the technical features of the technology in question. When you try to sort of think through what regulation would even mean, and again, staking is a term of art more than anything else. There are so many different forms of staking, different platforms, different networks, and the like. But is there a kind of maybe a useful order of operations from a regulatory standpoint when trying to think through, how would you even begin to regulate? Because as far as I can see, it's not just a banking question, and in fact, it may even be a capital markets question first, and then you get to the banking stuff later. But if you have any tips, it'd be helpful.
Historically, the way regulation has worked for risky assets and not perhaps the most perfectly informed persons is by restricting the amount of money that they can invest. So that's sort of a tried and true way. I think providing information is also a tried and true way. So there are rules on, say, funds, what they have to disclose. You could think about all these things coming into play. There are a couple of what effectively are credit rating agencies in this space that provide code verification, and they provide sort of other information. That is, you could also think about that as being provided. I think one of the things that's particularly worrying about crypto is that regulation has to be done by international bodies because there are no boundaries. And so it requires a different way of thinking about how a regulatory structure should work. And that's like a really difficult problem. Yeah.
Okay. Just one last question. Augustine?
Sorry to ask so many questions, but great presentation. Let me ask a more fundamental question. Do you think that a lot of the traction that crypto is gathering has to do with the fact that traditional finance and traditional money has not evolved at the speed of technology and responding to what people needs. So let me put one way. I mean, if we had, for example, a wholesale central bank money or reserve currency, technologically advanced, do you think that that could make up for the demand of stable coins? I mean, for example, stable coins, I mean, one of the reasons why I don't like is that when you talk about money, if you need to put as a previous adjective stable, that tells you that there is something wrong there.
Yeah.
Or there is some vulnerability there, no? Now, stable coins are backed by US treasuries or by cash, which at the end of the day is the real thing. So shouldn't we concentrate more on making the real thing, you know, to be able to be represented technologically in such a way that the space that stable coins or crypto is filling would be filled in a more solid way? I don't know if my question is clear, but
it all comes down to trust. So if you have a world where everyone trusts Tether and everyone uses Tether to make payments, it's very difficult to see why anyone would switch at this point to something that is issued by one central bank. If it is in fact the case that these stable coins are used internationally, then why should I care about central bank A when I'm in jurisdiction B? Why not just take this large international company that seems to be multinational and doesn't seem to have sort of strange biases? So I think at this point it's very, very difficult, or it will be difficult, for central banks to come up with some dramatic exceptions, central banks to come up with a widely adopted stablecoin that basically could overtake things like Tether.
Thank you very much, Christine. I think that's an excellent note on which to end the session. We appreciate your presentation. Let's give her a round of applause.